One firm is worth 50 million and 80 million at once. Both numbers are true, inked on the same ledger page. The gap that saved him from ruin was hiding here. Column A asks what rebuilding this whole firm costs. Column B asks what its yearly profits are worth today. Skip either one and you can be wiped out. Today, you learn to read a $30 million disagreement. You will value any company twice on one page and know whether to buy, wait, or get wiped out. Most people value a business once and get ruined. They cling to one number until it goes worthless. A single column that cost one buyer 30 million, he paid 80 million for a rich stream of profits. He never checked the assets and it destroyed him. The number that wiped out his margin sat in column B within 3 years. Those profits crashed to nothing. A rival copied the plant and his customers vanished. His $80 million business collapsed back toward 50 million. A skipped column cost him 30 million and left him broke. Feel that knot tighten in your stomach right now. That loss was not bad luck. It was one skipped step. The mistake that ruined that trade takes seconds to catch. Two of his rivals had already copied the whole plant. In column B, the $30 million crash was already visible, so start with column A or risk being wiped out. Column A is what Graham called reproduction value. Picture raising it brick by brick on an empty lot. Price the land, the plant, and every delivery truck. Add the inventory stacked in the warehouse right now. Add the receivables customers still owe on the ledger. Add the cash to open the door each morning. Then add years of ad spending that built the brand. Sum every piece into a $50 million column A. That total is your reproduction value, the cold floor. The question that every smart rival secretly asks you. Graham built this to stop you overpaying and going broke. The value that almost nobody computes ends bad deals. Notice this floor ignores the profits completely. It counts only bricks, trucks, and shelves on the ledger. A dying firm and a thriving one can share it. That is the point. Column A stays coldly factual. Now build column B, the earnings power value. This column ignores bricks and reads the profit chart. Ask what the firm earns in a normal, non-crash year. Not the best year, not the worst, a middling one. Strip one-time gains, the honest profit is $8 million. Smooth that number across a full business cycle. Say that steady profit is $8 million every year. Now ask what a dependable $8 million is worth. Divide it by the 10% return you demand. 10% means $8 million becomes 80 million. 8 divided by 1/10 equals $80 million of value. That $80 million is earnings power value, your column B. It assumes zero growth, the same profit forever. Growth is a bonus. Pay for it and you go broke. Both numbers come from the same annual report. One reads the balance sheet, one reads the profit page. No forecasts, no dreams, only what already exists. This is how Buffett sizes a firm in minutes. Reproduction cost is what plain economics guarantees you. Free entry drags fat profits back toward that $50 million floor. The premium that vanished the moment you ignored this. So the asset floor is your anchor in a crash. Everything above it is a claim that can collapse. Now, two honest numbers sit side by side. 50 million of bricks, $80 million of earnings. The whole method lives in the gap between them, the line that finally separates a moat from a mirage. When column B towers $30 million over A, ask why. Something lets this firm out-earn its own asset floor, the edge that rivals should have already destroyed. High profits invite rivals who crash your margins. They copy your 50 million and split the customers. Competition drags earnings down until latecomers go broke. So an 80 over 50 gap demands one hard question. What stops a rival copying this $30 million edge? The moat that justified the premium was never there. No barrier and the whole gap has already vanished. Those $30 million profits evaporate and you're left broke. But sometimes a real barrier holds the rivals back. A trusted brand, a network, a locked-up market. A cost no newcomer can match without going bankrupt. That barrier is a moat and the gap is earned. A real moat means the $30 million premium is safe. So a gap up means moat or costly mirage. Prove which you hold or you get wiped out. Now flip it. Sometimes column A towers over B. The assets outvalue profits when managers destroyed them. 50 million of plant earning like just 30 million. The managers that quietly run assets into ruin. The chairman that destroyed the assets still drew a bonus. Someone is torching $50 million of solid assets. That gap screams mismanagement or a dying industry. The mismanagement that quietly turns $50 million into $30. Good assets in weak hands are worth more sold. A better owner or a breakup unlocks the floor. So fix management, sell, or watch the value collapse. When both columns roughly agree, you can finally breathe. No moat, no rot, just $50 million of fair value. Then only price decides if you profit or go bankrupt. Which brings the third and simplest reading of the gap. Lay the market price beside both of your columns. A cheap $40 million price means nothing if assets rot. A price below both columns is the gift you want. You pay under the bricks and under the profits. Overpay above both and you get wiped out. A price above both columns is the classic trap. Buffett hunts exactly this mispricing every single day. Let me walk one full example you can copy tonight. Call it a small regional bottler in a quiet town. First column A, the cost to rebuild it. Plant and delivery trucks would cost $30 million today. Inventory and receivables add another $12 million. Rebuilding the brand would cost $8 million more. Reproduction value lands at $50 million, your column A. Now column B, the earnings power value. In a normal year, it nets $8 million after tax. You demand a 10% return on your money. $8 million divided by 10% is $80 million. Column B stands at $80 million of earning power, 80 over 50. A $30 million gap swings open. So you ask the only question that really matters. What stops a rival building a $50 million plant here? Every store in the county already stocks these bottles. A newcomer cannot win the shelf. Most go bankrupt trying. The moat is real. The $30 million gap is earned. Now check the last number, the market price. The whole company trades for just $40 million for $50 million of assets and $80 million earnings. Pay under both, and you rarely get wiped out. That space is your margin of safety. A worked page like that turns fog into a decision, but run the same page on a firm without a moat. The earnings that vanish the moment a rival arrived. Same $80 million column B, same $50 million floor. Yet any rival can build the plant. Profits crash. The number that disagrees is quietly warning you. Trust the cold asset floor, not the flattering profits. That single check would have saved our ruined first buyer. He would have kept his $30 million fully intact. So here is Graham's whole method on one page. Draw a line straight down the middle of a page. Left column, add the cost to rebuild everything. Right column, normal profit over your 10%. Then set the market price beneath them both. If 80 beats 50, hunt the moat or run. If 50 beats 80, suspect the managers or the industry. If price sits under both, you may have found gold. 2 numbers, 1 page, 10 honest minutes of work. You now value any business twice before you buy. That habit separates investors from broke gamblers. Remember the buyer who lost $30 million to one column. Both his numbers sat on the very same page. The gap that saved a careful buyer was there all along. This channel teaches the tools, never the hot tips. Every video hands you one skill you can truly use. Subscribe and value a real company with this page tomorrow. One firm worth $50 million and $80 million at once. Now you can read exactly which number to believe. Next, the honesty test hiding in every chairman's letter.